The silver market collapse. A critical alert. This represents the most significant market announcement we have ever issued. I urge you to temporarily ignore the price ticker. Stop fixating on those red and green candlesticks blinking on your display. Quit constantly refreshing the COMEX data, wondering whether we're heading toward $100 or retreating to 92. Because I'm informing you with complete conviction that the numbers on your screen are becoming meaningless. The figures you're watching are phantoms. They are remnants of a system that fractured this week. What truly counts now, what separates those who preserve their wealth from those who lose everything, those who remain financially stable from those facing insolvency, is the underlying architecture of the market. It's the infrastructure. It's the mechanics. It's the implicit understanding that enables transactions to occur. And as of Wednesday, January 21st, 2026, that architecture has officially fractured. The infrastructure has ruptured. The machinery has seized. We are announcing a liquidity crisis in the American wholesale precious metals market. For half a decade, we have been sounding alarms. We cautioned about supply deficits. We warned about depleting stockpiles. We flagged the declining mine production. But what's unfolding today isn't merely a deficit. A deficit suggests the system functions. There simply isn't sufficient product. What's happening today constitutes a systemic breakdown. It's complete cardiac arrest of the exchange mechanism supporting the entire Western precious metals sector. We have just obtained confidential trading documents from a primary authorized dealer for the United States Mint. For those unfamiliar with how this sector operates, allow me to clarify the structure. At the foundation, you have individual retail buyers, people like us. Above them sit the neighborhood coin dealers. Higher still are the internet-based bullion merchants. But at the apex of this hierarchy, positioned directly alongside federal institutions, are the authorized purchasers. These are the enormous wholesale distributors. These are corporations with billion-dollar financing arrangements. These are the sole entities permitted to acquire directly from the U.S. Mint. They form the nucleus of the marketplace. They circulate silver throughout the economic bloodstream. Typically, each morning at 8 to they distribute a pricing document to their dealer networks. This document functions as a catalog. It enumerates thousands of items. It includes American Silver Eagles. It lists Canadian Maple Leafs. It covers 100-ounce industrial bars. Alongside every item appear two figures, a purchase price, what they'll compensate you, and a selling price, what they'll charge you. That document proves the market lives. It demonstrates liquidity exists. Today, that catalog stands empty. I'm examining the document at this moment, and what I observe is alarming. On the selling column, the section indicating what retailers can acquire for customers, the status is consistent. It's a cascade of red notifications. Depleted, depleted, depleted. American Silver Eagles, unavailable. Status unknown. Restock date uncertain. Standard Buffalo rounds, gone. 100-ounce commercial bars, gone. They're literally declining orders for any tangible silver product. The warehouse shelves at wholesale tier aren't merely vacant. They've been stripped clean. If a neighborhood coin dealer contacts this distributor today and announces, "I have a client with $1 million ready to purchase silver," the distributor must respond, "We cannot assist." The physical metal simply doesn't exist. Deficits indicate elevated demand. The alarming element, the indicator signaling total breakdown of the exchange mechanism, is the purchasing side. Ordinarily, when a dealer runs dry, when they're desperate for stock, they broadcast their need for supply. They elevate their purchase prices. They signal to the market, "We'll compensate you $2 above spot. We'll pay $5 over spot. Just deliver the metal." That's how a functioning market addresses scarcity. Elevated prices remedy insufficient supply. But not today. Today we're observing an anomaly that shouldn't mathematically exist. The status on the purchasing side, the amount they'll compensate for your silver, reads no offer. Let that penetrate your consciousness. No offer. The major distributors have ceased acquiring metal. They've deactivated the purchase function. If you transported an armored vehicle to their facility right now carrying 10,000 ounces of immaculate silver bars, they wouldn't unlock the entrance. They wouldn't present a bid. They'd send you away. They'd state, "We cannot acquire this. We don't want it." How is this conceivable? How can an enterprise simultaneously be depleted, desperate for merchandise to sell and offering nothing, declining to acquire merchandise at the exact same moment? It appears contradictory. It sounds irrational. If customers are extending cash toward you, why wouldn't you acquire the metal to supply them? Because this has transcended a supply problem. This has become a capital problem. This constitutes a liquidity death spiral. It's not that they don't desire the metal. They're desperate for it. Their enterprise depends on possessing it. The issue is they lack the funds to compensate for it. The distributors are maxed. Their bank balances are immobilized. Their financing arrangements are exhausted to the absolute ceiling. Their cash reserves have vanished. They're occupying empty facilities, immobilized, incapable of restocking, and incapable of transacting. They may be solvent theoretically. They might hold assets. But they're stranded because they possess no liquidity. They literally cannot issue a check for your silver. This represents the moment when the market stops functioning as a market. A market necessitates two components, a purchaser and a vendor. Currently, in the American wholesale sector, we have neither. We have vendors, you, who cannot locate a purchaser. And we have purchasers, customers, who cannot locate a vendor. The intermediary, the connection linking both sides, has crumbled into the void. The engine has locked up, the lubrication has evaporated. And when the wholesale market freezes, the complete supply network freezes alongside it. The neighborhood coin dealer cannot restock, so they close operations. The internet dealer cannot hedge their exposure, so they expand their margins to 50% or they disable the website. The liquidity evaporates. You might be wondering, how did this occur? How did the largest, most financially robust companies in the sector exhaust their capital during the greatest silver surge in history? Shouldn't they be prosperous? Shouldn't they be swimming in earnings? That's the harsh paradox of the financial system. The very instrument they employ to protect themselves is the instrument destroying them. The mechanism they utilize to safeguard their enterprise against a decline is the exact weapon devastating them during a surge. To comprehend this catastrophe, to grasp why $90 silver represents a death verdict for the dealers, you must examine the hedge. You must examine the trap they constructed using the COMEX. We need to expose the concealed reality of the bullion sector. We need to explain the margin call catastrophe, currently extracting every cent of liquidity from America. We need to clarify why the banks are demanding repayment. Let's examine the mechanics of the collapse. Let's understand why success has transformed into failure. The paradox of rising prices. You're probably sitting there confused. You're likely observing silver hovering near $99 and reasoning, wait, if these dealers have warehouses loaded with silver and the price just quadrupled, shouldn't they be celebrating? Shouldn't they be acquiring vacation properties? It's a reasonable question. If you possess an asset and that asset skyrockets, you prosper. That's how it functions for you. That's how it operates for the individual stacker. But that's not how it functions for the distributor. And this is the hidden reality of the bullion sector that nobody discusses. This is the mechanism that has converted the greatest bull market in history into a funeral procession for the very people who constructed the market. You must understand that a wholesale bullion dealer is not a speculator. They're not wagering on silver rising or falling. They're a logistics enterprise. They're a transport company. Their business model is straightforward. They acquire a bar of silver for spot plus $1, and they transfer it to a coin dealer for spot plus $2. They generate revenue on the margin. They generate revenue on the turnover. They don't care if silver stands at $20 or $200. They simply want to circulate the metal. But to operate such an enterprise, to maintain $50 million of stock in a warehouse without going bankrupt if prices decline, they must protect themselves. They must insure their inventory. And how do they accomplish this? They utilize the COMEX. They employ the futures market. Every time a major distributor acquires 1,000 ounces of physical silver for their inventory, they immediately execute a short sale of 1,000 ounces of paper silver on the COMEX. Why do they do this? Because it renders them market neutral. If silver drops $10, they forfeit $10 on the physical bar in their vault. But they gain $10 on the short position, and the two neutralize each other. They're protected. It permits them to rest peacefully. It enables them to secure massive financing from banks because the bank observes that the inventory is hedged. It functions beautifully in a stable market. It functions beautifully in a declining market. But in a violent, vertical, explosive rising market, it becomes a suicide mechanism. Let's calculate the catastrophe unfolding now. Imagine a dealer acquired 1 million ounces of silver when the price stood at $25. They invested $25 million for the metal. And to hedge it, they sold short on the COMEX at $25. Everything is stable. The bank is satisfied. But then China implemented export controls. Then the supply panic materialized. Then silver rocketed toward $100. Now examine the dealer's financial position. On the asset column, they appear brilliant. Their physical silver now carries a value of $99 million. They have a massive theoretical gain. But examine the liability column. They're short at $25. The market stands at $99. They're losing $74 on every single ounce they hedged. That represents a theoretical loss of $74 million. Theoretically, it still equalizes. The asset covers the obligation. They remain neutral. But there's one distinction, one fatal distinction that destroys companies: cash flow. The physical silver in the warehouse doesn't compensate you with cash until you liquidate it. It simply occupies space. But the short position on the COMEX, the exchange doesn't wait. The exchange demands cash every single evening. It's termed a margin call. When prices rise $1, the dealer must transfer $1 million in cash to the exchange by morning to maintain the position. When prices rise $74, they must transfer $74 million in cash. Not silver, not commitments. Immediate, tangible fiat currency. Where does a dealer obtain $74 million in cash overnight? They don't hold it in their accounts. Their capital is locked in the metal, so they borrow it. They possess revolving credit arrangements with the major bullion banks, JP Morgan, Bank of America, HSBC. These credit arrangements are structured to manage normal fluctuations. But this isn't normal fluctuation. This constitutes a hyperinflationary event. The price movement has been so aggressive and so rapid that it has depleted the credit arrangements. The dealers have borrowed every available dollar the banks will extend to satisfy the margin calls. They've exhausted the credit limit. And now the bank has communicated no more. The bank has stated, "We will not advance another dollar. You're over-leveraged. You present too much risk." This constitutes the liquidity freeze. The dealer is positioned atop a mountain of silver valued at hundreds of millions of dollars. They're technically wealthy, but they're cash-starved. They're illiquid. They cannot liquidate the silver rapidly enough to generate cash for the margin. And because they've maxed their credit arrangements, they cannot acquire new silver. If you approach with your silver to sell to them, they require cash to compensate you, but all their cash is flowing to the COMEX. All their cash is satisfying the margin clerk at the exchange. So they post the no offer sign, they suspend the purchasing desk, they halt operations. It represents the supreme irony. They wagered on the dollar. They utilized the dollar system, the futures market, to protect themselves. And now the decline of the dollar, which is propelling silver upward, is demolishing the dollar-based hedge sustaining their enterprise. They're shackled to a descending vessel. The physical market wants to soar, but the paper anchor is dragging them beneath the surface. And don't imagine for a moment that the banks will rescue them. The banks, JP Morgan and the others, are the entities collecting the margin calls. They're the parties on the opposite side of the trade. JP Morgan holds the long position, the dealers hold the short position. JP Morgan is draining the dealers. They're extracting their cash, and soon they'll claim their inventory. When a dealer defaults, when they cannot satisfy the margin call, the bank seizes the collateral. The bank dispatches trucks to the warehouse and claims the physical silver. This constitutes consolidation. This represents a takeover. So the American wholesale market currently exists in a condition of suspended operation. It's a zombie market. The lights illuminate, but nobody operates. The system displays sold out because if they liquidate the metal, they must unwind the hedge, and they lack the cash to realize the loss. The system displays no offer because they lack the credit to acquire. It's a standstill. The Eastern arbitrage. India and China take control. And while America remains paralyzed by this financial engineering catastrophe, while New York suffocates under its own paper derivatives, the rest of the world isn't waiting. The rest of the world doesn't hedge. The rest of the world transacts in cash and carry. And there are nations that have detected blood in the water. There are nations that perceive the Western paralysis and view it as the opportunity of the century. We must redirect our attention eastward. We must discuss India and China. Because while American dealers fixate on their margin calls, Eastern dealers are observing record premiums and activating the vacuum cleaner. Let's examine Mumbai. Let's observe what an actual market resembles. The gravitational center for global silver has violently relocated. It has migrated 8,000 miles eastward. It has settled in Mumbai and Shanghai. And if you want to understand the actual silver price, if you want to witness a free market when the paper restraints are removed, you must examine the Multi-Commodity Exchange of India, the MCX, and the Shanghai Futures Exchange. Because currently, the East isn't merely participating in the market. The East is dominating it. Recent trading data reveals historic numbers. In Shanghai, silver has been settling at substantial premiums. Reports indicate $6 to $9 per ounce above COMEX prices. Canadian silver companies have received offers from Chinese and Indian buyers willing to pay $8 to $10 above market price simply to secure physical metal. Let me repeat that for the traders in New York to comprehend. Eastern buyers are paying significant premiums over Western prices, and that doesn't represent a premium cost for a specialty coin. That's the wholesale benchmark rate for commercial bars. Now contrast that with the number displaying on your American screen. Your screen shows $99. Eastern markets show substantial premiums. Usually silver flows from the mines in Mexico to the vaults in London and New York. That's the traditional pathway. But today the pathway has been rerouted. Why would a Swiss refiner sell a bar to a New York bank at spot when they can transport it to Mumbai or Shanghai and sell it at a premium? They wouldn't. They're capitalists. They pursue profit. America is being depleted. The United Kingdom is being depleted. We're witnessing massive physical migration, and the metal is departing the West, where it's treated as a paper gambling instrument, and flowing to the East, where it is treated as monetary substance, and the rationale for this urgency in the East is specific. It's pressing. China implemented export controls on silver beginning January the 1st, 2026, citing its strategic importance for clean energy and defense applications. Rumors have circulated in Asian markets about potential import restrictions. The Eastern population recognizes their governments. They understand that when authorities threaten barriers, they implement them abruptly. So the population is front-running the restrictions. They're panic purchasing. It's a stampede. Households are acquiring jewelry. Farmers are buying traditional silver articles. Business people are acquiring bars. It's not speculative acquisition. It's cultural acquisition. It's wealth preservation acquisition. And unlike Americans who purchase paper ETFs, Eastern buyers acquire the tangible article. They take delivery. They retain it. This Eastern premium represents the death sentence for the COMEX. You cannot sustain a paper price of $90 when the physical market transacts at substantial premiums. The arbitrage is too compelling. Traders, the astute ones who still maintain credit arrangements, are purchasing the discounted paper contracts in New York, demanding delivery and shipping the metal overseas. They're stripping the COMEX to supply the East. This explains why the wholesale market in America has broken. American dealers can't compete. They can't pay Eastern prices because their customers domestically won't pay them, so the metal bypasses America entirely. The United States has become a flyover zone for the global silver trade. The metal flies over New York and lands in Mumbai and Shanghai. And this generates a feedback mechanism. As metal exits the West, the shortage in New York intensifies. The sold-out notifications we discussed become permanent. The no offer. Liquidity crisis deepens because no metal flows back into the system to replenish liquidity. It's a one-directional flow. The East acquires, the West hemorrhages. There's the COMEX delivery explosion. And while Eastern buyers extract the physical market dry, something profoundly disturbing is occurring in the paper casino supposedly regulating all of this. Something has shifted in the behavior of the major banks on the futures exchange. For weeks, they were executing maneuvers. They were rolling their positions. They were postponing the reckoning. But recently, the music ceased. The strategy changed. We must examine the COMEX deliveries. We must examine the January contract because the data reveals that the banks have stopped rolling and started taking. They recognize what the East is doing, and they're preparing for the vault to empty. Let's analyze the data. Let's identify who's standing for delivery while the rest of the world remains distracted. While the wholesale dealers freeze and the East burns hot, the most revealing signal is originating from the one location that typically deceives us. It's emerging from the center of the beast. It's emerging from the COMEX futures market in New York. For the preceding 3 weeks, we observed the banks executing a very particular strategy. It's termed rolling. They were taking their positions in the spot month and frantically rolling them forward to subsequent months. They were postponing the reckoning. They were signaling, we don't want the metal now. We'll address it later. They were desperate to avoid delivery. They were desperate to perpetuate the paper game. But recently, something shifted. The music stopped, the rolling ceased, and the taking commenced. We've analyzed delivery data, and the behavioral shift is undeniable. Instead of pushing contracts into the future, the banks suddenly decided to hold firm and demand the metal immediately. According to recent COMEX data, in just 7 days, approximately 33.45 million ounces of silver were physically withdrawn for delivery. That represents roughly 26% of COMEX's registered inventory vanishing in a single week. Let's contextualize that figure. 33 million ounces in a week. In a normal period, you might observe 2 million or 3 million. We're witnessing an extraordinary surge in physical demand. This isn't a trading anomaly. This constitutes a bank run on metal. The entities holding these contracts examined the Eastern premiums. They observed the sold-out signs at the U.S. Mint, and they concluded, we're not waiting for later. Deliver the bars today. And who's leading this charge? Who's the one entity that consistently appears to know precisely when the music will stop? J.P. Morgan. Out of recent delivery notices, their house account stopped, meaning they claimed possession of a substantial majority of the entire daily volume. J.P. Morgan is clearing the floor. They're functioning like a vacuum inside the vault. Why would they do this? Why would they take massive delivery now instead of rolling to later dates? Because they perceive what we perceive. They observe the liquidity freeze in the wholesale market. They observe the Eastern vacuum extracting metal from London. They understand that if they wait, the metal might not exist. It might be in Mumbai. It might be in a solar panel manufacturing facility in Shenzhen, so they're claiming it now. They're securing the physical asset before the system completely seizes. And the danger isn't concluded just because January is ending. Open interest figures, the number of contracts remaining active, indicate potential demand for millions more ounces in coming months. If those contract holders stand for delivery, and why wouldn't they with the East paying premiums, it will devastate the available inventory. We're observing consecutive months of record extraction. The breathing room the banks were anticipating, the typical winter pause, has been canceled. The extraction accelerates. This signifies a market that has lost confidence in the future. In a healthy market, traders contentedly hold contracts for future delivery. They trust the system. In a dying market, nobody wants a promise. Everyone wants possession. The fact that rolling has stopped means trust has evaporated. The banks are essentially declaring, "We don't trust you to possess this silver in 3 months. We want it in our truck by Friday." This represents the psychology of a run, and it connects perfectly to the liquidity freeze we discussed earlier. The dealers are freezing because they're short. The banks are taking delivery because they're long. The capital is migrating from the weak hands, the hedged dealers, to the strong hands, the vaults of JP Morgan and the Eastern buyers. It constitutes a consolidation of wealth on an unprecedented scale. The dollar trap, why success became failure. But here's the tragedy. Here's the cruel twist of fate that renders this situation so desperate for the American industry. The entire U.S. precious metal sector, the dealers, the distributors, the logistics companies, is failing not because they were wrong about silver. They're failing because they were wrong about the dollar. They linked their destiny to a weakening currency. They utilized the dollar-based system to ensure their real-world assets. And now the dollar is dragging them into the abyss. We must explain this systemic irony. And we must clarify why being market neutral in a monetary crisis constitutes a death sentence. Let's examine the trap. Let's explain why the industry is dying while the asset is thriving. There's a cruel, dark irony positioned at the center of this crisis. If you scripted this as a film, Hollywood would reject it for being excessively tragic. We're observing the complete collapse of the American precious metals industry, the dealers, the distributors, the logistics networks, and it's occurring for the exact opposite rationale you'd anticipate. Usually, when an industry fails, it's because nobody desires their product. Blockbuster failed because nobody wanted to rent DVDs. But the silver industry, they're failing because everybody wants their product. They're failing because the price of their product has skyrocketed. And the reason they're failing reveals the fundamental flaw in the entire Western financial structure. It reveals the fatal mistake every major dealer in America committed. They attempted to construct an enterprise based on sound money, gold and silver, but they constructed the foundation on fiat money, the dollar. You must examine the philosophy of the hedge again. When a dealer shorts the COMEX to protect their inventory, what are they actually executing? Mathematically, they're wagering that the dollar and silver will maintain equilibrium. They're utilizing the paper derivative, which is a creature of the dollar system, to ensure the physical metal. They effectively chained their lifeboat to the Titanic. They believed the chain would keep them stable. They believed the chain represented safety. But now the Titanic is sinking. The dollar is weakening. And because the dollar is weakening, the price of silver is exploding toward $100. And that chain, that perfect hedge, is dragging the lifeboat down with the vessel. This constitutes the margin call we discussed. The margin call is simply the cost of betting on the dollar. Every time the dealer must wire cash to JP Morgan to cover their short position, they're paying a penalty for trusting the fiat system. They're hemorrhaging capital because they refuse to simply hold the metal unhedged. They were too fearful of volatility. They were too fearful of price declines. So they insured themselves against a decline, but they never insured themselves against a melt-up. They never insured themselves against the dollar dying. And now they're the victims of their own prudence. And there's another layer to this catastrophe. It's termed capital intensity. Back when silver stood at $25 an ounce, a distributor with a $10 million credit arrangement could move 400,000 ounces of metal at a time. They could operate a massive enterprise on relatively modest credit. But today, with silver at $99, that same $10 million credit arrangement only acquires 100,000 ounces. Their purchasing power has collapsed by 75%. The metal price has risen, but the bank's willingness to lend hasn't. The banks aren't providing 4 times the credit just because silver costs 4 times as much. Actually, the banks are providing less credit because they observe the volatility. So the dealers confront unprecedented financing constraints. That's the polite corporate terminology for "we're broke." They literally cannot afford to operate their enterprise at these price levels. Silver has become too expensive for the intermediaries to handle. It's like a gas station that can't afford to purchase the gasoline to fill the tanks because oil reached $500 per barrel. The gas station closes even though everyone needs gas. The silver dealer closes even though everyone needs silver. This explains why the purchase button is disabled. This explains why the no offer sign is posted. They're suffocating from insufficient working capital. And this creates the ultimate misalignment of interests. Currently, you, the stacker, the investor, you're cheering for silver to reach $150. You want the moon. But your dealer, the person you purchase from, is secretly hoping for a crash. They're hoping for silver to retreat to $50 so their margin calls cease, so their capital extends further, so they can breathe again. The industry is at war with its own customer base. The rising price is enriching the holder, but destroying the distributor. This marks the end of the just-in-time model, the model that relied on cheap credit, stable prices, and infinite paper hedging is dead. It cannot survive in a hyperinflationary environment. And as these American dealers fail, as they reach their credit limits and freeze operations, They leave a vacuum. They leave a void where supply used to exist. And we know who fills that vacuum. We know who steps in when the weak hands fold. The East steps in. JP Morgan steps in. The entities with actual capital, the entities that don't need to hedge because they genuinely want the metal, are taking control. We're witnessing the transfer of the silver market from the paper hands of the Western dealers to the diamond hands of the Eastern accumulators. The final verdict, where this leaves you. So where does this leave you? It leaves you standing before a broken machine. It leaves you holding fiat currency in a world where the people who sell real assets can no longer accept your money. The wholesale market hasn't merely paused, it has expired. And we must accept the reality of the verdict. We must summarize what happens next. Because if you believe you can simply wait for conditions to normalize, you're mistaken. This constitutes the new normal. The freeze is permanent. Let's conclude. Let's examine the final verdict. So here's the verdict. We've examined the trading documents. We've observed the sold out signs on the selling side and the no offer signs on the purchasing side. We've examined the record-breaking Eastern premiums. We've examined the internal collapse of the American wholesale dealer network, which is currently suffocating under the burden of its own debt and margin calls. The diagnosis isn't complicated, it's terminal. The American physical silver market currently exists in a state of cardiac arrest. The heart has stopped beating. The blood has stopped flowing. We're examining a market that is technically open, but functionally deceased. You must understand the gravity of what no offer means. It means that the liquidity, the ability to convert your asset back into cash instantly, has evaporated. It means that if you're holding silver in the United States right now, you're holding an asset disconnected from the local financial system. You cannot sell it to the distributors because they lack money, and you cannot acquire it from them because they lack metal. The bridge is collapsed. The only path to cross the river is to travel where the bridge still stands, and that bridge exists in Mumbai. That bridge exists in Shanghai. This brings us to the most important realization you must make today. The price you observe on your screen, the $99 trading on the COMEX, is becoming increasingly irrelevant. It's a zombie price. It's a price that exists only in a computer simulation where infinite leverage and infinite paper promises still function. But in the real world, the world where you need physical metal to manufacture a solar panel or protect your wealth, that price is becoming fiction. The real price is whatever the Eastern buyer is willing to pay to secure their family's future. And the gap between the zombie price and the real price represents the cost of the collapse of Western trading infrastructure. The shift in global power. We're witnessing the end of an era. For 50 years, New York and London dictated silver prices to the world. They utilized their paper derivatives to control physical reality. Today, that control has officially fractured. The West has exhausted its physical metal, and now it has exhausted the credit necessary to pretend otherwise. The scepter has been passed. The East is now the captain of the vessel. The East is establishing the price, and the United States is merely a bystander watching its own financial infrastructure explode. So what's your move? If you're holding paper, if you're holding an ETF or an unallocated pool account, you're standing in the middle of the liquidity freeze. You're holding a claim on a dealer that might be insolvent by week's end. You're holding a promise from a system that has already defaulted on its own logistics. Get out. If you can still redeem for physical, do it. If you can't, recognize that your paper position is a trap. And if you're holding physical silver, do not sell. Do not let a desperate dealer convince you to sell for $99 so they can survive another day. Do not throw your life raft to a drowning bank. Your silver is the only thing that's real. The wholesale market has died so that the true market can finally be born. The manipulation is over because the manipulators are broke. This is the reset. The sold out sign is permanent. The no offer is the silence before the scream. The Western system is finished.